Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. Just like that, the S&P 500 is back to its uptrend line support. After a very disappointing CPI reading, the market got surprised. It was very optimistic leading up into the reading that was released right here on the 13th of September, and you can see the market reaction, a violent 4.5% drop, retracing almost the entire rally that we saw since the 7th of September. A huge amount of concern amongst investors, a huge amount of fear, and you can definitely understand why, because right here, we are at a pivotal technical structure on the S&P 500. We are back to that 3,900 support level right here. That was a very important zone of support around this area. Also retesting this trend line here that goes back to that June low, captures the July low. And you can see I've adapted the trend line support here. This is really the final trend line support, the final bullish structure that the market could hold before really seeing a more intense move down. You can see it broke this trend line here, capturing the two initial lows and that September low. Big breakdown here. But I always like to give the benefit of the doubt before jumping to conclusions on such a big level like the 3,900 support level. And you can see if we duplicate this trend line here, the market loves symmetry. That's how technicals work. You can see it also corresponds to these two highs here. So now we're back to retesting it. I cannot stress how important this technical level is for the market. And we've discussed this a few times, right? First of all, this is the 61.8 retracement level from this rally here. Why do we use Fibonacci retracement levels? Because it gives you what a typical counter trend move can look like. Typically, it falls between 38.2 and 61.8. If you start to go below 61.8, you can't say that this is a counter trend move anymore. You have to say that this is, in fact, a downtrend, right? So breaking that level would confirm that this is not an uptrend, right? This was not just a counter trend correction within a broader uptrend, and that this is in fact a resumption of the downtrend. So it breaks one of the key bullish structures we have. So the only real uptrend line that's left on the market, and you've got a pattern here. I don't know if you guys noticed, and this is not a textbook pattern, right? Head and shoulders are typically topping patterns, not continuation patterns, but they can work like this. If you get a break of that trend line, it gives you a measured target right here that should be equivalent to around the height of the head right here from the break that would take us rapidly down. Now, patterns aren't everything in the market, and you should definitely not rely on them completely, but it gives you an idea of where you're going to see significant breaks and when you can get a violent move in the market. When you've got this type of pattern and that's followed by a break, well, that can lead to a panic. So if 3,900 points breaks, all fundamentals go out the window, stop losses get hit along the way, and you could get a capitulation move filling this gap here where we have very little support between the 2020 high and the June low. A lot of people have been expecting this gap to be filled before looking for a bottom. That's been somewhat consensus that the market would retrace back down to that pre-COVID high. As we know, consensus 99% of the time is wrong, but sometimes you'll see consensus being right. Back in December 2008, consensus was that the economy was collapsing and we were seeing a major financial crisis that would be similar in size and magnitude to the Great Depression. The contrarian outlook was that we were going to start a new major bull run from that low. Consensus was right for another few months, right, as the market continued to capitulate before forming that significant bottom. So you can definitely understand why a lot of investors are concerned and why we're seeing a historical amount of hedging from large traders, right? At such a pivotal technical structure, you do risk capitulation in an environment where we have seen a lot of macro headwinds. And so a lot of market participants want to be protected against that. And of course, showing a level of pessimism that hasn't been seen since the 2008 financial crisis. Other less extreme readings have also coincided with major market bottoms like 2015 and 2018, and also, of course, the COVID low. But again, there are examples where consensus was right. 2008 here is an example where consensus was right for another few months, where these large traders that hedged were absolutely right about hedging, and it did protect them against another 30% move down in the market. Now let's try and put things into perspective here. Let's try and dissect what, first of all, the technicals are saying right now, and then also briefly discuss what this data release means for the market. Now, another important thing to mention from a technical standpoint, just focusing purely on the technicals here, is this rejection right here on the MACD. We were about to see a bullish crossover, market getting excited, getting optimistic, potentially fueling a breakout. And I really think if the CPI had been weaker than expected right here, it would have had the potential to fuel a macro shift where the sentiment goes from increasingly bad news to all of a sudden that CPI reading triggering a breakout. Of course, that didn't happen. In fact, the bullish crossover was rejected. Objectively, this is a bearish technical development. Seeing a rejection of bullish momentum like this, that is objectively bad news and decreases the odds that good things will happen in the near term, right? You can see what a successful bullish crossover can look like right here in June. It led to a 20% run on the SP 500. So until further notice, unless you get that type of curling back and seeing a bullish crossover, which could definitely happen, right? Short-term technicals can change on a dime, but until you see that, it's very difficult to see this development as anything positive. Now I can find one example that looks quite similar to this example that we have, and that is in May 2022 right here, that I see is actually pretty similar. You have a pretty intense downtrend here leading up to the 3,900 support level. Then you see a market bounce with clearly the MACD showing signs that it wants to cross over. Then you have a huge red day, 4.5% move, retracing that entire rally in just one trading session and making it look like the momentum is switching back into bearish momentum. Very similar here. Pretty intense downtrend down to the 3,900 support level. Rally, major rejection, momentum rejects, but we remain at support, just like we stayed above support on the 20th of May, and the market rallied significantly. Then, of course, we had the May CPI reading that was an absolute disaster that took the market for another leg down right here in June. But of course, that's another story. The point here is that this is a pivotal moment for the market right here, right now, at this support level. As we highlighted at the beginning, a breakdown would be catastrophic for the technical structure. But if we get a bullish crossover here, despite this reaction we had here, it really confirms that this was just a one-off reaction, that underneath the surface, the market is seeing through that reading and actually anticipating better economic data in the future and completely shrugging off that disappointing reading and having enough conviction to get back into that uptrend, getting back into that bullish momentum. Very important to have that complete picture. If you're just focused on one single economic data release and you're paying too much to one market reaction, you're going to get whipsawed around. The algos take over, they create these massive spikes in market volatility that are not necessarily always representative of a larger trend. And that's what we wanted to highlight in yesterday's article for our members. Support remains support until it's broken. Objectively, price is at support right now. If you're on your own, trading in this market can be incredibly difficult to stay level-headed, stay objective, despite all the noise that you see online. As soon as you get this type of day, as 4% red day, reaction to an economic data release, you go on Twitter, you go on YouTube, all the bears come out crying out victory, being very confident, when in fact this could just be a temporary market reaction with the market just retesting support and volume telling you there's a lot of demand. That's really what our core mission is. We try to put everything into perspective, Make sure that you're aware how the market can trick you, how it can manipulate you, how it can play on your emotions so that you can stay level-headed, objective throughout the investment process, whether that's bearish or bullish, depending on what the data is telling us, because that's what we know can give us a real edge on the market, not the noise. Everything else we have to throw out the window because there is too much information. We need to filter out and focus on what's important as investors. If following the markets, following our trades, our investment ideas, and how our perspective on the market by looking at our articles, video summaries, the trading watch list that we have, make sure to grab yourself a free trial. We do have one for 7 days if you want to test out our service. Now, the final thing I want to discuss in this video is the CPI reading here and briefly discuss why it was a disappointment. The biggest driver of the upside surprise in this CPI reading was actually shelter. Rents are increasing and contributing to higher headline CPI and higher core CPI. Now, from the research that we've done, the shelter component of CPI is a lagging indicator. It lags home prices by several months because of how it's constructed. Now, I'm not going to get into the details of it, but the primary reason for that is because it doesn't just take into account new leases. It takes into account all leases and has something called the owner's equivalent rent, which completely distorts the data. So it's very possible that this is one example where a temporary market reaction doesn't end up playing out. Yesterday, we posted a premium video and an article highlighting what the underlying dynamics around inflation are today. Is the market overreacting to the CPI report? Because I think understanding that CPI reading, understanding the current inflation dynamics and how that relates to the Fed is one of the key aspects to understand the market right now. And I think we are looking at that differently to most. So that's about all I wanted to cover in this episode. I hope you guys enjoyed. If you did, make sure to smash that like button and click on that subscribe button if you haven't already. Now, in the meantime, I wish you good luck on your trading and see you next time.